Hello traders, welcome to this series of educational videos that FXCM has for you. My name is David Londoño, I'm a trader and a market analyst, and today I would like to talk to you about the correlation between assets. Now, as I always tell you, you can find fantastic insight articles about the subjects we manage here on our FXCM platform. I will recommend you to check on this one where is a currency correlation. We're going to have an example about this article in a few minutes. But let's start talking about the analyzing correlations between assets. Analyzing the correlation plays a crucial role in portfolio diversification. I want you to be focus on this term, not right, the portfolio diversification, and how can we use this for do that. Now, the correlation refers to how the prices of two or more assets move in relation to each other. Here is an analysis of the correlation and its impact on the diversification. We have three different ways of correlations. We have positive correlation, negative correlation, and zero or low correlation, right? Let's just start talking about the positive correlation. And in order to do that, I have a great example for you on the, as I was telling you before, on this article. We have a part where it says correlation example, and let's check it. It says right here, during the period of January 1999 to August 2001, Euro USD and CHF USD had an exceptional daily positive correlation of 0.95. So essentially, these two assets or these two foreign exchanges moved in locksteps every day during this period. So I want to show you exactly those two during those periods. We have right here 1999 and August 2001, and we can see how a positive correlation is. So we have at the same time the break on the structure. We have definitely, for example, the buy side liquidity that it wasn't taken here. It wasn't taken on the franc Swiss the dollar. Right here, we have the Euro USD on our left, and we have the CHF USD on our right. We can also see when it was the buy side taken. It also happened on the other in the other pair. We have seen also on the sell side liquidity, same time it was taken, it was also taken, buy side again taken, buy side. And also very interesting as well, when we have a liquidity void on the CHF USD right here, and it was taken again, recalibrated, we can see that the same fair value gap was made on the Euro USD. As you can see, the correlation was extremely positive, 0.95. It goes from -1 to 1. So it was almost doing exactly the same movements, except right here, when we had a divergence, the Euro USD, we can see it didn't take the buy side liquidity. The CHF USD did it. So this was showing us that a break on the structure will be coming, a change from sell side movements, to bearish movements to bullish. As we can see right before the move, the correlation stopped being that positive. Right here we have a liquidity void that didn't take place at all on the Euro USD, and after this kind of divergences, so the bullish move just went. So I just wanted to show you this as an example of what a positive correlation is exactly on the charts. Now let's move on to the second and third kind of correlations. There are negative correlations and zero or low correlations, right? Now the negative correlation indicates that two assets tend to move in opposite directions, not as we were saying in this example. Also, the zero or low correlations, if two assets have a correlation correlation close to zero or very low, their movements are independent to each other. So this provides effective diversification as the movement in one asset are not related to the movement to the other. So that's when the impact of the diversification take places. We want to use this as a way of diversify our portfolio, we are not looking for positive correlations. We are looking for negative or zero or low correlations, right? Since portfolio diversification aims to reduce risk by spreading investments across different assets with low or negative correlations, as I was saying. In doing so, the goal is to minimize exposure to adverse events that may affect a single asset or asset class. So we are trying to put a shield under our trades or above our trades. If something comes with the calendar or something happens around the world that affect one asset, if they are negative correlated, it is very possible that the other asset won't be that affected. If you like it, if you find this interesting, I recommend you to check on our Insight articles. So as I was saying, also don't forget to subscribe and share with your fellow traders. And for now, I have to say goodbye. So have a profitable week. I wish you good luck and good trading.